Well, this next 6 months and beyond is a crucial time for digital assets, but also wholesale tokenization. And we're really moving into a new phase of real mass production within the financial services industry. Currently, there are around $30 billion of tokenized assets out there. That's excluding stable coins. But that's expected to rise dramatically towards the end of the decade to $1 trillion plus, depending upon whose estimates that you look at. And that's going to create enormous opportunities for novel products and for new ways of industry engaging with one another as counterparties. In particular, there's going to be a big focus now on secondary market trading, creating liquidity in digital assets and tokenized products of all kinds, because that's what will unlock real world opportunities with things like intraday liquidity for corporate treasury management. So this next phase of artificial intelligence adoption across the industry is going to see a move from what has to date been quite a fragmented approach to more of an enterprise-wide strategy. And a big part of that is firms starting to look at that build versus buy model in relation to large language models. And part of that is recognizing the power and the value of proprietary data. And that will drive more of a hybrid approach as we move forwards. And that will also allow for the creation of agentic AI solutions for clients, which is where we're really going to see that value creation for institutions and for their clients. And then a big part of that really is about turning the philosophy, if you will, around artificial intelligence in the industry from a productivity tool to a revenue generation tool. There are so many different use cases out there that could arise from that. For example, the creation of more assets under management by the use of AI to create unique and bespoke information flow for institutional investors. So what's coming next over the forthcoming 6 months for private markets? It's been a turbulent 12-24 months, both in terms of capital raising and investing, but we're starting to see real green shoots of opportunity both on the exit side, but also with secondaries becoming much more mainstream. We're also seeing a lot of focus on new potential asset classes, particularly in the infrastructure and real asset space, and a particular focus on redefining, if you like, infrastructure to include defence and national security assets. And then you can't talk about the future of private markets without talking about retail investment. That's currently around 17% of all capital raised. That's likely to rise to well over 20% by the end of this decade and beyond. And that's going to be catalysed in no small part by changes in the Department of Labour rules in the United States around how people can invest their retirement plans. I hope you have enjoyed this latest edition of Navigator, and I hope that you find our thought leadership thought-provoking and helpful in your business decision making. We always warmly welcome your feedback, so if you have any questions about what is in this edition of Navigator, please don't hesitate to get in touch with me or your usual Evershed Sutherland contact. Thank you.